There's been lots in the news this week about higher rate income tax, in particular about how many more people in the UK are expected to start paying income tax at the higher rate. What are they talking about? Firstly, let's talk about how income tax works. The rate of tax you pay is determined by how much income you receive in total in the tax year. For most people, that primarily comes from earnings and self-employed income or pensions, but it also includes things like interest on bank accounts, rental income on buy-to-let properties, some types of investment income, and various bits and pieces like that. You're allowed to receive a small amount of income each year and pay no tax at all. That's called the personal allowance, and it's currently £12,570 a year. As soon as your income exceeds that level, you start paying income tax on the excess. So for example, if you earn £20,000 more than the personal allowance in the year, you pay income tax on that £20,000. Currently, the rate you pay on things like earnings, pensions and rental income is 20%. It's a little bit different for certain other things like share dividends. The idea of higher rate tax is to tax those who can afford it, i.e. the higher earners, a bit more. Currently, that threshold sits at £50,270. So if your total income from the year exceeds that threshold, you'll pay tax on the excess at 40% instead of 20%. The rates go up again if your income exceeds £100,000 and then £150,000, but we're not going to go into that today. Now, this system's been in place for years, so why is it suddenly in the news? The reason is this. Under normal circumstances, the price of things we buy goes up each year. That's called price inflation. The amount of money we all earn each year goes up. That's called wage inflation. And generally speaking, these tax thresholds go up each year. If those three things go up at broadly the same rate, the system pretty much works. However, these are not normal circumstances. So one of the Chancellor's measures to recoup some of the billions the government have spent in the wake of the COVID pandemic is to freeze these tax thresholds. According to the latest figures, wages in the UK are going up on average by 4.9% a year. That means there are many people who will cross that threshold and start paying higher rate tax, not because of promotions or big bonuses, but just because of normal inflation. Now, a new study by the House of Commons Library suggests that 1.5 million people that currently don't pay income tax at all will start paying the basic rate. 1.2 million people who pay basic rate will cross that threshold into higher rate tax. The total cost of this to UK taxpayers, according to this study, is around about £11 billion. If you think you're likely to be one of the people caught out by this, what can you do? First of all, don't panic. You'll only pay extra tax on the bit over the threshold, not on all of your earnings, so the effect isn't likely to be catastrophic. The Telegraph published an article this week that caught my attention, claiming you never have to pay higher rate tax even if you earn £90,000 a year. Now, their suggestion is you put everything over that higher rate tax threshold into a pension. That does work in theory, but it's a fairly clumsy strategy and unlikely to work for many people in practice. Still, it made a good headline. Maximising pension contributions is a very important and effective strategy, but there are lots of other things that you should consider as part of your tax-efficient financial plan. Make sure you've used up all other discounts and allowances. Capital gains tax, for example. If you're a higher rate taxpayer, why would you invest in buy-to-let property and pay 40% tax on rental income when you can invest in a diversified investment portfolio and only pay 20% capital gains tax, or nothing at all on the first £12,300? Make sure you use your annual ISA allowance to protect savings and investments from income tax and capital gains tax. If you're a couple and only one of you pays income tax at the higher rate, consider whether there might be advantages to putting savings, investments, rental properties, for example, in the name of the lower earner. Consider tax deferred investments. So if you're a higher rate taxpayer now, but you're likely to become a basic rate or even a non-taxpayer in the future, for example, when you retire, consider investments that are taxed at the end. If you have an appetite for investment risk, things like enterprise investment schemes and venture capital trusts have some massive income tax advantages. They're not for everyone though, so proceed with caution. As with anything like this, the best thing you can do is take independent advice, put yourself in an informed position and plan ahead.